place I'm living in is called a beautiful delusion.
Good day. I'm Marjorie Martin Cruz, one of the reporters for Module 7, Accounting for Inventory, which contains Introduction for Accounting Inventory, Inventory Valuation, specifically FIFO, Lower of Cost or Net Realizable Value Rule, Cost Flow Assumption, and Inventory Cost Flow Assumption.
Good day everyone, I'm Hazel Colette. I'm going to report about accounting for inventory. Every business that manages inventory must use an inventory accounting for process to determine the value of the company's inventory assets. There are several common inventory accounting methods that companies rely on to assign a value to their inventory and maintain appropriate record keeping. Inventory valuation is a critical business process that directly impacts profit and taxation. On hand, inventory isn't simply stock that hasn't sold yet. It's a business asset and must legally be treated as such. Inventory accounting is the practice of correctly valuing this business asset so it can be properly documented in end-of-year financial records. Inventory accounting is a business asset. Accounts must consistently and appropriately use an acceptable, valid method for assigning cost to inventory to record it as an asset. Raw materials, work in progress, and finished goods remaining on site should all be considered part of the inventory. Inventory accounting is a vital business practice for manufacturers, wholesalers, and retailers. Many of these product-based businesses face the challenges of assigning value to inventory on hand as opposed to inventory sold, since identically goods carry differently prices as time goes by. Sticking to a specific method for inventory valuation is critical for consistent, accurate, and most importantly, legally acceptable financial statements. There are three main valuation methods retail companies use for inventory accounting. First in, first out, FIFO. Last in, first out, which is LIFO, average cost method. You'll need just stipulate which one is being used when submitting financial record and accounts, and these three will be elaborated by my groupmates. The most direct approach to costing inventory is the specific identification method. However, the companies find it impractical. Instead, they make a cost flow assumption. In absence of specific identification, most flow assumptions allow a company to decide which unit cost will be assigned to cost of goods sold and to inventory. These assumptions include FIFO, LIFO, and average cost.
Good day. I am Marjorie Martin Cruz, reporting for Module 7, specifically Inventory Valuation. Before we start, what is inventory valuation? Inventory valuation is an accounting practice that is followed by companies to find out the value of unsold inventory stocks at the time they are preparing for their financial statement. Inventory stock is an asset for an organization and to record it in the balance sheet, it needs to have a financial value. Inventory valuation allows a company to provide a monetary value for items that make up their inventory. Inventories are usually the largest current asset of a business, and proper measurement of them is necessary to assure the accurate financial statements. Inventory valuation can be calculated by multiplying the number of items on hand with the unit price of the item. And there are three types of inventory: raw material inventory, work in process inventory, and finished good inventory. Also, there are four accepted methods of inventory valuation. The first one is specific identification. Next is first in, first out, or also known as FIFO, last in, last out, or also known as LIFO, and weighted average cost. However, we will only talk about first in first out, or commonly known as FIFO, which is the most common method for inventory valuation. First in first out, or FIFO, is an asset management and valuation method in which assets produced or acquired first are sold, used, or disposed of first. For tax purposes, FIFO assumes that the asset with the oldest costs are included in the income statement's cost of goods sold. To calculate FIFO, determine the cost of the oldest inventory and multiply that cost by the amount of inventory sold. Inventory is assigned cost as items are prepared for sale. This may occur through purchase of the inventory or production cost, through the purchase of materials and utilization of labor. These assigned costs are based on the order in which the product was used, and per FIFO, it is based on what arrived first. For example, imagine if a company purchased 100 items for $10 each, then later purchased 100 more items for $15 each. Then the company sold 60 items under the FIFO method. The cost of goods sold for each of the 60 items is $10 per unit, because the goods sold purchased are the first goods sold. Of the 140 items remaining in the inventory, the value of 40 items is for $10 each per unit, and the value of the 100 items is $15 per unit. This is because the inventory is assigned the most recent cost under the FIFO method. With this remaining inventory of 140 units, let's say that the company sells an additional 50 items. The cost of goods sold for the 40 of these items is $10, and the entire first order of the 100 units has been fully sold. The other 10 units that sold will be cost $15 each, and the remaining 90 units in the inventory are valued as $15 each. The FIFO method follows the logic to that avoid obsolescence. A company would sell the oldest inventory items first and maintain the newest item inventory. Although the actual inventory valuation methods used does not need to follow the actual flow of inventory through a company. An entity must be able to support why it selected use of particular inventory valuation method. Thank you.
Again, good day. I'm Laimi Kulagbang from BFBA FM 2A, and the part that I will discuss is about the lower of the cost or net realizable value rule. After inventories have been manufactured or acquired, their net realizable value, that are the market price net of any selling cost, value will increase or decrease. We use lower of cost or net realizable rule because value of a good can shift over time. It will also let companies to record losses by writing down the value of the affected inventory items. The lower of the cost or net realizable value rule is associated with the conservatism principle. The conservatism principle prevents the recognition of any increases until the item of inventory has been sold. However, if net realizable value declines below acquisition cost, a common occurrence for goods that carry high obsolescence risk, the inventory is judged to be impaired and must be written down. The lower of the cost or market rule traditionally applies to companies whose products become obsolete. The rule also applies to products that lose value due to dwindled current market price. For example, an ABC company that sells wallet. And these are the cost information regarding the inventory of ABC company. The purchase cost is $250. The replacement cost is $150. Normal profit margin is $20. Selling price is $200. Selling cost is $40. To find the net realizable value, we will going to subtract the selling price, which is $200, and the selling cost, which is $40. So the net realizable value is $160. The net realizable value minus a normal profit margin is $140. Thus, $160 minus $20 is equals to $140. In this example, replacement cost falls between net realizable value and net realizable value minus a normal profit margin. Therefore, the replacement cost used is $150. Comparing the amount of the purchase cost of $250, a $100 write-down is necessary.
Good day everyone! I am here to report the cost flow assumption, an example, and inventory cost flow assumption, a summary. The definition of cost flow assumptions. The term cost flow assumptions refers to the manner in which costs are removed from a company's inventory and are reported in the cost of goods sold. In the US, the cost flow assumptions include first in, first out, and last in, first out, and average. Each specific identification is used. There is no need to make an assumption. First in, first out, last in, first out, average are assumptions because the flow of costs out of inventory does not have to match the way the items are physically removed from the inventory. Example of cost flow assumptions. To illustrate, let's assume that a company has 4 units of the same product in its inventory. The units were purchased at increasing cost and in the following sequence: $40, $41, $43, and $44. If the company physically removes and sells the oldest unit, the unit that had a cost of $40, the cost removed from inventory and reported as the cost of goods sold will vary depending on the cost flow assumption. Under the first in, first out cost flow assumption, the oldest cost of $40 is removed from inventory and charged to cost of goods sold. Under the last in, first out cost flow assumption, the most recent cost of $44 is removed from inventory and charged to cost of goods sold. Under the average cost flow assumption, the average cost of $42 is removed from inventory and charged to cost of goods sold. Other than a one-time change to a better cost flow assumption, the company must consistently use the same cost flow assumption.